And we're live, I believe. Hello, everyone. My name's Gaurav Sodhi, and joining me today is analyst Graham Witcomb. Hey, Graham.
Hey, Gaurav.
I see you got the memo about the the college shirts. I don't know about you, Graham, but I'm at home today, and underneath this shirt is stuff that you do not want to see. Week old,
Okay. This is
week
not
old
that kind
gym
of show.
shorts. No, no, not that kind of webcast. So, how are things looking over there?
Good. It's getting dark out here, so I'm in Vancouver to anyone who doesn't know me from the podcast. But yep, so it's about to get dark. If you see the lights suddenly dim,
Hmm.
then that's the explanation. It's not my background lighting.
I've got the opposite problem. It's really sunny outside, and I just got competing light streaming in from this window. So, apologies for the dark demeanor today. It looks a bit darker than I wanted it to. But welcome, everyone. Thank you for giving us an hour of your time and listening to us. I thought for the format today, this is just a one-off webinar that we're holding for members, for subscribers, for trialers, and for those thinking about becoming any one of those in any one of those categories. But it's just Graham and I today, and I thought we'd just go through a few of our impressions on reporting season. I actually have a slide that we had prepared earlier. Let's do that. Oh, there's some important information there that you cannot read, but is absolutely vital. And if you can't read it, you're going to be in trouble. Next one. Okay.
Hope you got it.
We go, I hope you got it. No. Look, that's just a regular disclaimer that this is everything we speak about is general advice, and treat this as such. So we are just going to be talking about some of the takeaways from reporting season, just some of the things that the team is looking at, how we're thinking about particular stocks, and we may even get to a stock or two that we have upgraded recently. Graham, I can think of one right up your alley. If you have
Yeah, I
questions,
can think of a couple.
if you have questions, we do have a question panel down the side, and a I'm going to be keeping an eye on that. So if you have questions, pop them in, and we will try and get to them as we're going along. Um, I can see actually one of our members, Prashant. You've said that there's no audio. Um, if anyone else is having trouble with audio, please just write it down. And I think oh, yep, there we go. Thank you. It does default to mute. So if you need to turn the sound on, that might be the reason why you can't hear us. So that should help. Graham, we have just finished one of our busiest periods of the year. Reporting season is a chance for us to check our thesis on stocks compared to the real information that's coming from those businesses. It's a chance to hear from management, to look at the numbers, to hear guidance, and also to check up with companies that we don't always check up on and that we only keep a periodic eye on. So it's a huge amount of work to be done, a large numbers of stocks covered along a wide array of industries. What do you reckon? How was it? How was it for you?
I actually found it a pretty peaceful reporting season. I think coming
Mm.
through COVID, I was used to the massive swings, the big, I don't know, earnings downgrades and all that kind of stuff. But this reporting season, I felt like it got to the end of it and there were no massive bruises or bumps or even the big excitements along the way. So it was a fairly placid one, I thought. What about you?
I had expected more fireworks. So there was a few consensus views that were going to be tested this reporting season. I thought it was going to be a particularly important one. Everyone in the markets, every investor is waiting for the Australian consumer to fall. You know, interest rates, they look like a brick wall. When you look at a time series of interest rates, there's this wall in the way, and it looks very scary. It's actually been the sharpest increase in interest rates on record. It's happened simultaneously across the world, and it's coincided with other cost of living pressures. Energy prices are high, everything at the supermarket's higher. So naturally, the idea was that the consumer would be under pressure, and you'd start to see that in retail numbers. And you saw it a little bit. Baby bunting was probably the best example of that. Graham, I don't know if you saw that result, but it's a stock I keep an eye on, and it was a really bad number. And I'd say they have a strategy issue over baby bunting as well as a cyclical issue. They've been closing down, well, not closing down. They've been moving their store opening away from larger warehouse format stores into malls, and that changes the customer base a little bit. It may change the proposition as well. The great thing about baby bunting has always been families can drive in. The parking is right in front of the store. It's a flat access to the store, so no stairs or no elevators, and you can get ancillary services like car fittings, car seats, and things like that. And big box deliveries go straight in the car, which is usually a few meters from the store. So there's reasons why that format has worked. And I do wonder whether this new mall-based format is working. So that's a business that may have its own issues, but may also be representative of what's been happening with the consumer. But then we got to stuff like JB Hi-Fi knocked it out of the park. Accent Group, fantastic. Supermarkets were strong. I was really surprised. Did you see any evidence of what we all expected, a weak consumer?
Not really. I thought that, well, there was maybe in Coles and Woolworths results, you see a little bit of that because although if you just kind of focused on their revenue line, it all looked great. A lot of that was just because of them increasing the prices of goods rather than people buying more. So I think that their New Zealand, Woolworths New Zealand business is actually maybe a better tell of what's happening where you would see volumes go down and all of the top line growth was just down to increasing prices. So yeah, that tells me that maybe the consumer isn't as resilient as it kind of looks on the surface. But at the same time, yeah, I felt the same through most of the results. There wasn't anywhere near as much blood in the streets as you might have expected.
Yeah, that may be yet to come. I was watching there's a time series that the ABS releases on savings rates, and it's just one to keep an eye on every now and again. And the saving rates over COVID just absolutely soared for very obvious reasons, I think, and they're now being drawn down. So there's a buffer there that's being used, and it won't always be there. So I do wonder how long this will last. It's completely counterintuitive to not see as much consumer pain as I think we probably were expecting. But so far,
Yeah,
so good.
sure.
Now, what about on the other side? Were there any results that really stood out to you as being particularly strong, particularly surprising?
Uh, well, I suppose Coles and Woolworths were in one way. Also, the reaction to ResMed was a big one.
Hmm.
I thought that got clobbered by the market, but yeah, it wasn't really justified by the underlying numbers. You kind of expect it coming out of COVID to be, uh, yeah, selling fewer machines and then all of that kind of flowing through because they had such a bump a couple of years. But yeah, it just hasn't really. Uh, I don't know. I guess the investors didn't really see that going in somehow.
Hmm. We'll
You
get
would
to
think that
ResMed.
there was a bigger reaction.
ResMed is a really it's now become almost a battleground stock, and it's a really important one to dive into. We will get to that in a moment. But I wanted to first bring up Aussie Broadband, which I think I've mentioned before, but I think that was one of the standout results, a really important one for them this time around, because they are undergoing a strategy change from being an NBN reseller towards more higher margin, higher service offerings. So they're actually selling services to enterprise and government customers, and a lot of that involves the use of their own infrastructure, which means some higher margins. Almost a completely different pivot to what they've been doing for the last 20 years. So this result was important to see if they could successfully make that pivot, and the outcome was yes, they can, and they're doing it very well. So it was a really important result for them, one of the best in reporting season. And sometimes the share price gets these things wrong, and I would say this time the market has got it right. And you could see from the reaction to Aussie Broadband's results that the change in strategy, the increasing quality of that business is actually being noticed by the market now. And I think we had on our ballot list for a long time, Graham. It's been a long-standing stock in our universe, and it's now, I think, getting wider recognition.
Yeah, I think you've been right on that one for right from the start. I remember when you were first presenting it, thinking, "Oh God, another like telco. It's going to be another disaster." But Yeah, I think you called it from the beginning that that's a much higher quality business than I would have expected.
It was a really hard one to convince the team on, because there was no obvious competitive advantage, and that was the leap to make,
Yeah,
recognizing superior management, superior culture, and a long track record of growth and success as a competitive advantage. These businesses,
yeah,
Graham, they can go from 0 to 1. They can start something from nothing and keep that growth going. Those are businesses I really notice and pay attention to. Those are the businesses that the market typically ignores, and they don't capture the full value. And more of my personal portfolio is now going into those kind of situations rather than more obvious competitive advantages where markets recognize it, priced it, and you might do well out of it. But if something changes, then your downside is really, really large. Now that kind
yeah.
of is the perfect segue into a stock that that you cover, ResMed, which fits that bill perfectly. Here's a stock, Graham. It's been a remarkable success story over decades and decades. We've had it on and off our buy list for a long time. You've been the analyst on it for as long as I can remember, and here it is, sort of 50% below its low. What's happened? Was the result awful? Is everything falling apart at the seams? Are we no longer
No,
sleeping? What's happening?
I don't think any of that. I think that it's coming out of 2 years worth of, well, maybe even 4 years of kind of the best 4 years it could possibly have imagined. That you start off with a pandemic, and then straight after that, you have your major competitor pulling out of the market for 2 years due to a product recall. And I mean, ResMed could have really cleaned up over this past couple of years in particular, except
Mhm.
because it was also following the pandemic, they kind of got stuck with their own supply, that they had capacity issues with actually getting the pieces put together. So at one point, I remember they were even flying things in on a private jet, which is just unsustainable,
Mm.
because they couldn't get the parts quick enough to actually build and fill the demand that Philips recall had been creating, and then the pandemic had kind of added to that. So yeah, they've come out of a good couple of years, but then they've landed in this situation at the moment where there just seems to be a ton of hype. I don't know what caught on in the past kind of 3 or 4 months, uh, but there's just a ton of hype around weight loss drugs at the moment. There were some interesting kind of clinical trials that came out that said that maybe we'll get these weight loss drugs as pills instead of as injections, which would open it up to a lot more people.
Mm.
And yeah, any stock that's affected uh, by weight gain or anything like that has been really kind of hammered at the moment. So yeah, ResMed's a key candidate because they get a ton of sleep apnea patients caused by just being overweight. So
Yeah, it is a key factor in sleep apnea, not the only one. Before we get onto that downturn, the reason the share price had run up so hard and so far, partly was because a competitor, Philips, had had issues with a recall, and they were pretty much absent from that market. How important was that, and how legitimate was that in driving the share price as high as it went?
well, I think it was huge. The That said, I think that people probably overdid it on the way up. Uh, they were kind of extrapolating out a long way. I think different broker reports I saw had ResMed capturing kind of more than 50% of the market, which probably is a bit of a stretch. I think my main concern would be when Philips comes back later this year and early next year, then they're really going to push hard on marketing and particularly discounting. I'm guessing Philips kind of has a history of price discounting as a way of competing against ResMed, which has a
Mm.
generally kind of superior product. So yeah, after they've been out of the market for 2 years, they're probably going to go heavy on their previous tactics, I'm guessing. So ResMed will probably lose a little market share over the next year or two as Philips comes back, but that installed base is there. They sold seven
Yeah,
years worth of product in just a year, basically.
that's incredible.
So
Yeah.
yeah, you couldn't have asked for a bigger blessing for ResMed, basically.
And just to go back to that installed base, so that means all the machines that they sold, that ordinarily would have gone to Philips and went to ResMed, they are now collecting consumable revenue from those sales into perpetuity. Is that the right way to think about it?
Yeah, not necessarily perpetuity, but Yeah, the good thing about
until they
CPAP
get onto those
devices,
weight loss drugs anyway.
yeah, maybe. Yeah, as soon as they sell a device, ResMed tends to make a ton of money afterwards based on the mask. So the masks tend to be higher margin than the actual devices. And so, yeah, when you sell a device, you have to keep buying masks to use it. Uh, and so the installed base over the past couple of years, because it's grown so much with Philips out of the market, that's really a multi-year kind of effect. It's not just we got some extra sales in 2023 or 2022. This
Mm.
will carry on for at least 5 years. Then the insurance will start clicking over and people will start like buying new machines to replace their old ones. And so maybe you see around then some switch back to Philips, particularly depending on how Philips kind of goes about attracting customers back. I'm guessing heavy discounts, but
Mm.
there's also going to be a lot of people that just get familiar with ResMed's machines. They like it. We know familiarity tends to breed loyalty. So there's a good chance that a lot of the people picked up by ResMed over the past year or two are going to be customers for life, basically.
Now that was a narrative that was running about ResMed for quite some time, that they were going to permanently win market share from the misfortune of Philips, and that did cause the share price to run up. I've rarely seen such a rapid change in story, because as soon as these Ozempic weight loss drug stories started coming out, the narrative around ResMed changed universally and very quickly, particularly in the US. I think that the where it trades also in the US, and it's been hammered over there, and it's kind of translated to the CDI listing here in Australia. But talk to us about that a little bit, Graham. What is the thesis? I mean, we've sort of danced around it a little bit, but let's spell it out. What are the bears saying about ResMed? Why is the share price falling?
Well, the basic bear case for it is that a a large portion, at least kind of 30% of ResMed's customers are overweight. That's a leading contributor to their sleep apnea. You've now got these drugs that are being developed. Well, some of them already on the market, but some also kind of being developed that are going to be a lot easier to administer. And if a lot of people start taking these drugs, they're shown to reduce people's weight by 10 to 15%. They cut people's appetite quite a lot. And if people are losing weight, then this sleep apnea will probably start to clear up. It's not going to get rid of it completely. For some people, it might if they're on the milder kind of zone. But there's going to be plenty of people that still need CPAP devices after this. I don't see how these weight loss drugs are going to cure all sleep apnea out there.
Maybe can I play devil's advocate here for a moment? What about the future pool of customers? It surely reduces that pool, doesn't it?
Well, it does. It does reduce the pool. So the way I kind of think of it is a bit like a bell curve. There's going to be mild and there's going to be moderate and there's going to be severe sleep apnea patients that ResMed's trying to treat. At the moment, it mainly deals with moderate and severe cases. A lot of the mild cases don't even know that they've got it unless they've got a spouse who is very good at hearing in the night. And so it'll probably just move the bell curve a little lower. If more people are losing weight, yeah, it's going to start curing some of the people that are in the mild sleep apnea. It's going to
Mm.
make moderate sufferers probably a little milder, and it'll bring the severe sufferers maybe down into the moderate range. But we're still talking the thing about ResMed that also kind of helped it over the past few years in the run up is that it's still a pretty unpenetrated market. That we're talking 1 billion sleep apnea sufferers worldwide, and
Mm.
ResMed has just a fraction of that. So there's still a very good chance that even if it cures all of the people that are kind of suffering from sleep apnea because of weight issues, that you're still going to be left with a very large market of maybe 500 million people, or at least many hundreds of millions. And yeah, if ResMed can keep doing what it's doing, which is boosting kind of awareness, making more and more convenient devices and more comfortable kind of masks, then that's still a very large market that it can kind of grow into. So
Mm.
you don't need the weight loss drugs to be failures for ResMed to do well. there's room for both of these in the market, basically.
Okay, let me offer two opinions here. Firstly, I have never owned ResMed for the sole purpose that it's always been kind of expensive. And I've always thought, for me, one of my primary filters in buying a stock is, does this business adequately solve the problem for a customer? And I think the device, the sleep, what do you call it, Graham? What's it called? The actual device?
The CPAP device?
The CPAP. The CPAP device is a lousy. It's a really poor. Um,
Vacuum
it's a
cleaner.
terrible way to. It's a terrible way to treat the problem. It's a poor solution to a very difficult problem. You basically, it's a little machine that pushes air down your throat. You got to wear this mask, carry on around a big heavy machine. It's noisy, it's expensive, and it's uncomfortable. And so far, it's the only really effective treatment. But this is as you say, this is a huge problem. And I've always been skeptical that you cannot solve this major, very profitable problem in a better way than throwing a vacuum cleaner on your face.
Yeah, I
And
mean,
that's why I've never owned it.
yeah, I 100% agree. Its biggest issue, ResMed's biggest issue for the long term, and its key risk, like throughout its history, has
Yeah,
been that it solves a problem in a way that nobody likes. And so that's just kind of inviting something better to come along and eventually make it obsolete. Uh, and there's a lot of believers out there that think these weight loss pills are the answer,
yeah.
that it's going to cure a lot of, it's going to cure a lot of sleep apnea with a pill, which is a way better result than what ResMed offers. So yeah, that will happen, but it's still a large enough market without any real alternative to CPAP for severe sufferers of sleep apnea and even the moderate ones.
Well, the other side of that argument is just take a look at the history of the business. You know, it may not be the optimal solution to this problem, but it's the only one available. And this company has come from nothing, from a zero start to dominate the industry. It's been really well managed over multiple generations. It's successfully moved into software, and I think that's really interesting. That move into software and the promise of using cloud software to control and optimize these machines is really interesting. You can gather a lot more data, personalize the unit a lot more. And they have perfected the actual business model itself. You know, the kind of consumables revenue, the very high margins. There's no question. This is an outstanding business and a true success story over decades. We're now being presented a consensus that that says that this whole investment case is broken, and I think history shows that when you pick up a fantastic quality business with very strong management and a very strong balance sheet at a time when it's really unpopular, most of the time you'll end up doing okay.
Yeah, 100%. And on top of that, you're getting it at a decent price. Like at the moment, it's kind of low 20s times its annual profits in terms of its market cap, which is much lower than it's been in basically a decade. So that price, that low price, is accounting for a lot of those risks.
Yep.
I completely buy that weight loss pills are going to be a risk to ResMed's business model, but you're also being compensated for that by kind of a lower price to earnings ratio than you've ever had in the last
Yeah.
decade, basically.
Was it
So
20 times? Is it, Graham? I mean,
yeah,
you could cheaper than Woolies. I mean, that just seems a bit absurd, really.
yeah, for one of Australia's best kind of healthcare stocks, it's a stock that completely dominates its market, that
Mm.
has also just had its key competitor, the only real major competitor to it, like completely crippled for 2 years. So I think it's going to be able to make the most of that situation over the
Mm.
next decade.
I'm going to put a question up. Peter says, I bought some ResMed this morning, but I found it hard. Do you find it hard to buy when there's bad news about? I really like this, Peter. I think this gets to the heart of good decision making and investing. The best decisions, the most profitable choices, are the hardest ones. I've had two big, all-encompassing winners over the last few years. One, they've been the coal stocks and Lovisa. I remember when I bought the coal stocks, my hand was shaking buying Whitehaven at $1. At that stage, it would look terrible. No one was buying it. It was probably a bad idea buying it then. And I felt sick, and I felt terrible. And I kind of knew that was, but when I was feeling that way, I kind of knew that meant it was a good decision. The best decisions are the hardest to make. I the hardest Lovisa purchase I've made was it right in the belly of the COVID downturn. The stock went from like $8 down to $2. I bought it $3 something, and the very next day it fell by 50%, and I almost threw up because it was just so difficult to watch this thing plummet so much, and there was so much uncertainty. We had no idea what was going to happen, but all that uncertainty, it's often the opportunity. That's when you get complete mispricing. You don't get mispricing when the outcome is certain and everyone is
Yeah.
optimistic. It
I
doesn't
feel
happen
much
like
more
that.
nervous buying stocks when there's only good news out. When I can see a lot of bad news out, then I can kind of rationalize it to myself that yeah, you don't want to
Yeah.
read the bad news, but at the same time, I know that humans have a tendency to overreact to bad news, which is where the opportunity is created. So if you're not reading bad news and you're buying the stock, you've got to
Mm.
start asking, well, why would this be mispriced right now? If everyone thinks it's doing great, then it's probably not undervalued.
I did think that about Facebook. We had a bit of a fight in my household. My wife was saying that Facebook at, what was it, like 9 times earnings, and it was $70 or something. No one wanted to touch it, and the consensus view was that no one uses Facebook anymore. It's going to be completely disrupted. They're throwing all this money into this silly 3D avatars, virtual, whatever it's called, and it's going to be a terrible outcome. And I at that time I didn't know that business well enough to fight the really awful feeling that you have in the pit of your stomach when you're about to buy a stock that's hated universally. And I wish I had. I think that thing is up 3 times since the depths of that downturn. Graham, do you have any experience? Give us an example of a stock that you bought that you felt terrible about and maybe threw up a little bit after you
I think
bought it.
I
All of them.
literally can't think of any stock that I've bought that
Yeah, yeah,
hasn't
yeah.
fallen immediately after I bought it.
Or that at least you've
Basically,
been
it's
uncomfortable buying it, right?
yeah, and that makes sense. Like, what are the odds that you're buying it at the all-time low? It's just
Yeah.
probably unlikely. So,
It's also
I mean, it
unnecessary.
just
I just think that ambition to try and buy it at its low point is just not necessary at all.
yeah, I think that gets you into trouble far more easily because
Mm.
then you're trying to time things. You almost inevitably wait for the stock to turn through some good news that comes out. But of course, as soon as the good news comes out, everyone jumps on board anyway, and you've missed the opportunity. So I think it'll be like this with ResMed, where it might continue to fall or flounder for another year or so, but then sometimes good things happen to great businesses with great managements, and then the tide turns, everyone kind of switches their mood, and then it
Mm.
gets back to what it really is worth, which is probably a lot higher than today.
I've thrown up this comment here from Prashant who says, "How low could RMD go?" I certainly not chastising you, Prashant, although I am a little bit because as an II member, we should know that we don't buy share prices; we buy businesses. But this is a really everyone when a stock is unpopular and when it's falling, our our attention falls to the share price rather than the business. And I think that's an urge we really need to fight all the time, and particularly at the pointy end, like now when the share price is falling quite a bit. As Graham sort of mentioned, the task here is not to buy it at its lowest point; it's to buy it below its fair value, and that's what we got to train ourselves to do. I mean, I just gave you the example of Lovisa. I bought Lovisa, at $3 something. It fell 50%. It went down to $2 something the very next day. And I know it feels horrible, and I felt terrible. But at no point did I think, oh, geez, I better sell. It's fallen. I mean, we got to get used to the fact that when stocks fall, us acting to buy them does not change the momentum in that share price. And I think the only edge we have is acting rationally when the market's acting in concert. So it's an important urge to fight.
Yeah, and you can always imagine it going lower. Like I'm a natural kind of pessimist when it comes to
Yeah.
stocks for sure. And I mean, you can just create an endless number of risks and ways that it could go lower, and it could. I mean, ResMed
Hmm.
could conceivably go to zero at some point. I mean, you can dream up situations where that would be the case. Suddenly, you get all of these, yeah, pills that are a success. You get some other cure. You get, I don't know, a product recall, just like what's it called? Philips had.
Yep.
I mean, you can always think of these things, but you can't deal with those outliers. You're just looking for being compensated for probabilities. And yeah, there are risks to investing in ResMed, but we think that you're getting a decent compensation for taking on those risks right now, and
Hmm.
that's what ultimately matters. Are you being compensated for the chance that something does go down significantly?
Now, that's a great segue into this good question from Paul as well, who says thoughts on infrastructure and REIT valuations, along with ResMed at the moment, and maybe retail. I think REITs are maybe the most disliked and avoided part of the market. So it is an area of the market that is interesting. It's the right sort of area to be looking at, but it's also an area we have to be very, very careful about. Infrastructure and REITs are highly sensitive to interest rates, and we know what's happened to interest rate. There's been a wall of higher rates. And I don't know about your view, Graham, but I think we're on the same page here. I don't think they're coming down in a hurry. I think we're in a situation where we're going to have highish interest rates for quite some time.
Yeah, I mean, I don't try to predict them, honestly. I can imagine situations where they do come down fairly quickly,
Hmm.
but that doesn't mean that they have to. And I don't want to kind of make bets based on whether I think they'll go up or down, because a few years ago I didn't think they could go this high either. So
Hmm.
I don't think I'm necessarily good at predicting the interest rates. But I've kind of shied away from REITs in general. I actually don't like them very much in general. But
Hmm.
we do have one on the buy list, which is Waypoint. But
Hmm.
that's a bit of a unique situation, I think, because it's in a that's again a case where you can make up a lot of negative news about it. It's so for people that don't know Waypoint, Waypoint owns a bunch of service stations, uh, or at least it owns the land beneath these service stations and then rents them out. And yeah, people are talking about electric cars coming on, and suddenly there's going to be far less fuel being sold and all of this kind of thing. And now with interest rates rising, there's that kind of anchor on its assets as well. But I mean, this is a collection of some of the best sites in any city. That these are all the corner blocks in main areas, and they can be redeveloped into all kinds of things. Uh, there's there's definitely value in this stock that isn't just tied to whether electric cars are a success or not.
Hmm.
And yeah, it's trading at a pretty decent discount to its net tangible assets. It's got a good yield. Uh, One of the, yeah, it may not be as attractive as it was uh, like a year or two ago when interest rates were much lower. You're getting a similar yield for against, yeah, very low interest rates elsewhere, but it's still a good sturdy business that has, yeah, a nice rent roll basically.
Yeah. I quite like that one as well, Graham. There are other REITs that are kind of interesting as well. It's an area we're thinking about a little bit. These infrastructure stocks, I guess, I'm probably less interested in those. Their valuation is really tied to interest rates, so it's almost a
Yeah.
direct relationship. High interest rates equal low valuations. It's just no getting around that.
Yeah, particularly those like Transurban where they just
Oh
load
yeah,
up debt over debt over
yep,
debt over debt,
yep.
and they are going to be clobbered when those all that debt load has to be refinanced because they're going to be getting way higher interest payments than before. And then you get the double whammy of not only do they have lower operating earnings because they're paying so much more in interest, but people are willing to pay less for those earnings as a multiple of them because they're comparing them against what you can get in a bank account and or a savings account. And
Hmm.
so, yeah, I don't like the direction of those ultra leveraged infrastructure stocks. I think they, with the exception of uh, Auckland Airport,
Yep,
I think that, but there's a lot more going on there than uh, just some ultra leveraged,
yep.
what's it called? Yeah, toll road.
Yeah, that Transurban wins my award for the stock that is perhaps most beloved. That I think is due for a large and unseen fall. I would be close to
Yeah.
shorting that stock. I don't understand the valuation on that business, and I don't think it's as good as everyone thinks it is. For
Yeah, I
one thing,
totally agree.
we've discussed this before, Graham, but this is actually a highly cyclical business that hides its cyclicality really well. A big chunk of that revenue and an even larger chunk of that profit comes from heavy vehicles going through those tolls. And when the economy slows, you just have less trucks running through. Graham, I think you pulled out internally, you showed us some data on Atlas Arteria and what happens to those European road tolls when the European economy slows, is that heavy traffic dramatically falls away, and that crimps the profits a long way. This idea that a road toll is just a license to print money, I think, is an incorrect one. I think the market's got this one wrong,
Yeah,
and
particularly
I
in
won't buy it.
Transurban's case, where it's everything's leased on relatively short leases compared to a lot of its competitors worldwide, where,
Yep.
I mean, in 30 odd years, it's basically going to have handed everything back to the government or
Yeah.
repurchased it or purchased other toll roads. So at least now with higher interest rates, it's going to be purchasing them at any other future roads at better valuations. But the
Mm.
ones that it purchased over the past few years or past 5 years were, even the past 10 years actually, were like the returns on capital are tiny for these because they had to pay such exorbitant amounts, which they were able to do by leveraging up a lot. So yeah, I don't like their business model at all. Uh, Transurban in particular, but a lot of the infrastructure stocks.
Let me throw up another question here, Graham. The pick between South 32 and Illumina. Illumina is currently on the buy list and is one of the most intriguing stocks on that buy list, I think. It has been an awful investment to date, but that kind of is what makes it interesting. Nobody wants to buy Illumina. There is rarely so much negative consensus on a stock, and that alone triggers my interest a little bit. We own Illumina across all the funds, and I put my buy order in recently for it as well, I might add. But it's interesting because Illumina owns the best, lowest cost alumina and bauxite assets in the world. That market has been savaged. Anyone in that alumina, bauxite, aluminium value chain is making no money. It's really tough. South 32, Rio Tinto, the Chinese, the Russians, no one is making money at the moment. Prices are low, energy costs in particular very high, and the commodity price has not reacted enough, although given time it will. And here you have a collection of assets that is irreplaceable. It's a collection of infrastructure, mines, and processing facilities tightly integrated over decades and decades. You can't replace that stuff. And at the moment, I think the replacement cost would be multiples of the share price if you try to replicate the asset base. Now, what it needs is it needs a couple of things. It needs higher commodity prices for a start. It needs to allocate capital sensibly, and Alcoa management. Alcoa is the joint venture partner of Illumina in their assets. Not good, not great management. Love to spend money, don't like to hoard it, and that's a big risk. The other big risk is regulation. To get that, to keep their costs down, they have to expand mining in parts of WA where they have to apply for new environmental licenses, and those licenses have been ticking over since 1960 without a problem, and this year they're much harder to get. Well, these days, their licenses in general are harder to get. So there's a lot more regulatory risk in that stock. And that is the main reason why no one wants to buy it. No one wants to touch this thing that has so much regulatory risk attached to it. And that's the opportunity. There's a potential decent downsize for Illumina, but equally, I think the most likely outcome is that the regulatory approvals tick over as they have for 50 or 60, 70 years, and this is a pretty cheap stock, which there's not too many of them around at the moment. So yeah, I think it's an interesting idea. Graham,
Hmm.
probably not one for you, I dare say.
Well, yeah, but I've been burned by not being interested in them. So at least in the past few years. So yeah, resources deserve a little more credit than I probably gave them a while ago.
I had to put up David's comment that yeah, around in the Sodhi household, David, the harshest arguments are always about stocks.
PEs.
Yeah, not necessarily PEs, but which stock is good, which business model is good. Even the kids are getting involved. I took my 8-year-old son, into his first Lavisa store last week, and we sort of, it was kind of weird because I think we're the only males within a 10-meter radius of the Lavisa store. We
I
just
thought
stood
it would have
there.
been more weird you judging gross margins with your son.
We just stood there and watched the operation. And he picked up that, look, there's only one person working there. It's a lot of customers. They're buying a lot of stuff. And I think that my 8-year-old son has just captured the investment case for Lavisa. It is just an extraordinary business. Graham,
Yes.
I bring this up now because I wanted to sort of get a best idea out of you. I'm going to talk about Lavisa first up. Now, Lavisa is very, very close to jumping on the buy list. It would just look. If you don't own Lavisa, we sort of said this in the articles as well. Then a buck here and there is not really going to change anything. We kind of we write we write recommendations, we have reviews, and we kind of have to stick to them. But really, as I said, it's growing so quickly. The upside is so vast that a buck here and there is not going to make a difference. But we do have to stick to some sort of limit. Have to draw a line in the sand somewhere, and the line is where it is. If you've been following my articles on Lavisa, you'd know that I'm crazy bullish. Graham, you're probably sick of hearing me talk about it. Pretty much on every meeting,
Oh, I
I
actually
bring up
love
Lavisa.
Lavisa. I think it's yeah, I think it's such an interesting little company because it defies what you expect from a retailer so well. Uh, those stocks that surprise you can, yeah, they can just keep on going. Uh,
Mm,
the bear case for it now is the same bear case that you could have made 3, 4, 5 years ago, and
mm.
it's just been proved wrong all that time. So who's to say the bear case isn't also going to be proved wrong now? It does have a long runway.
Well, I know the share price is much, much higher than it was. Well, certainly the last time we upgraded it, and in over the last couple of years. But look at the development of that business. I think you're buying a company that is just continuing to do what it has always done. You're not buying something new. It's not something unknown. We know the store economics are outstanding. In my view, the best store economics I've ever seen in any retailer. Superior to Lululemon, superior to Nike. Pretty much the best store economics I've ever seen.
Yeah,
And you
I think
combine.
that's a
Go
really
ahead,
good
Graham.
point. That I think the moment that it kind of changed for me with Lavisa was when I realized that you're not just buying a jewelry retailer, you're buying kind of a formula that these
Yes,
guys know
brilliant.
how
Yep.
to use, and they can keep doing the same thing in a cloned way. And you can even tell by just the sheer volume of stores that they open each year. It wouldn't be possible without a very rigid kind of formula that they were able to follow, and that formula
Mm.
just seems to work. So yeah.
Yep. And the upside potential here is enormous. We're talking only 800 stores. I think you could almost add a zero onto that, Graham. I think in the US alone, you could have 3,000, 4,000 stores. In Europe, you could have thousands of stores. It's not often you get a retailer with a vast international rollout. I don't think we've ever seen it in Australia, and that's why I think the opportunity exists, because we've never seen it. Now, of course, this is not to say there's a certainty. If that store rollout stops, if Visa suddenly stops being popular, if it's a fad, if a competitor replicates the formula, it's gone. It's finished. It's gonna take the
Yeah.
big tumble that ambitious retailers always take, which is why we have portfolio limits, and which is why we don't have single stock portfolios. But I think if you adjust for the risk, and you take that risk into account, and act sensibly within portfolio limits, and I still think this remains a fantastic idea, and it's one I'm particularly enthused about. What now? Apart from ResMed, Graham, do you have a best idea at the moment? One that you're particularly excited about, interested in?
Well, ResMed's probably my favorite at the moment.
Okay.
Uh, just because I can see a very clear, maybe going back to that question that we got earlier, but just because there's a
Mm,
very clear reason why it would be undervalued at the moment. So you can kind of, I love it when you know the bear case really well. And ResMed's an example of that. But I also like Sonic a lot.
Yep.
Sonic Healthcare is just, we've got a few interesting healthcare stocks on the buy list at the moment, which,
Well, you
yeah,
upgraded
hasn't.
CSL for the first time in a decade, I think. Is that right, Graham? The first time in 10 years we got CSL on the
Yeah,
buy
that
list.
was I'd been
Yeah.
waiting to upgrade that stock for, yeah,
I know.
basically since I
Yes.
joined,
Yes.
but
You've been
patience
itching to
eventually
upgrade
paid
that
off.
one. Yeah.
Yeah. Uh, but Sonic in particular is just, it's almost a Lavisa of healthcare, I would say, where it has a formula for plugging in small pathology labs and then extracting as much of the duplicate expenses that it can out of it, boosting margins, and then kind of repeating this same system. Uh, yeah, it's able to do that very, very well. The one thing it has going against it is that it tends to deal with governments as a single payer, or where they pay a lot through kind of Medicare or something like that. And so the government, in one way or another, sets prices. And as kind of healthcare budgets come under pressure worldwide, then you might get more pushback on pathology prices. But it's a vital service, so I don't see the government pushing prices to an extent where it's going to kill its main pathology labs. So yeah, Sonic is a good business for the long term, I think.
I'm going to
ResMed
throw up.
might be more undervalued, but I'd rather hold Sonic for 10 years.
I'm going to throw up a comment here from Karen, who says Levisa's treatment of staff was appalling. Ethics count. Look at Qantas. So
True.
Karen's referring to there have been numerous reports in the media about Levisa staff being treated badly. Levisa staff tend to be young and really au fait with social media. So when they're unhappy about something, everyone hears about it. Uh, look, my view on that is that this is a business with thousands of employees. A lot of them are very young, and the company, you know, it probably does. I mean, show me any organization that large that doesn't have a few unhappy people in it, and I just think that's a function of size. We're always looking for hints of across the board poor behavior. I think I just don't see that with Levisa at this stage, you know. And Qantas, to be honest, I don't see it with Qantas either. The reason we've been negative on Qantas is really um, the the weakness of the board in railing in the CEO has given him way too much power, and
Yeah, that's more a corporate governance
it's
issue.
more of a governance issue. And then you got
Yeah.
this capex problem where Qantas has, I think, artificially boosted its cash flow and its dividends and its profits by deliberately cutting back, you know, $10 billion of capital expenditure, which has kicked that can down the road, and it will still have to pay out. So I view the last few years of Qantas as dragging future earnings into the present, and it's going to have to pay that cost over the next few years. That's why we're not interested in Qantas. It's, you know, this look, I guess this is a very personal thing, Karen. People probably weight these data points differently. For me, it's a piece of information which I'll put in the memory bank, and we can collect other bits of information. And if they all coalesce into a giant negative ball, then it's time to act. But this is one data point, and there are others that I think supersede it. But as I say, it's a very
Yeah.
personal way to invest, and you know, your points well taken.
I also think with it, when it comes to stocks that you consider unethical or that have unethical boards, I think of them in the same way as voting in an election. That when you're a shareholder, you can actually vote. You can impact this company. So if you don't like how Lovisa is treating its members, then I mean, you can do what you're doing and kind of get the word out there. But I don't think the answer is to throw up your hands and say you don't want to own it as a protest, because that's just leaving the bad guys to own it. So I think that if you don't like an ethical, or you don't like the ethics behind a stock, then yeah, avoiding owning it so that the bad guys get richer faster than you isn't a great strategy. You're better off owning it and then voting in the different elections, get rid of the current board, that kind of thing. Put up shareholder questions in shareholder meetings and get them
I also
answering for
think
themselves.
company behavior is a really tricky thing. I mean, if you look at Apple, Apple is, you know, the top 3 most successful investments of the last 30, 40 years. I think it goes, actually, there's been a study on this. I think I got this right when I say Monster Drinks is number 1. I want to say Domino's. Is that Domino's US? Is that number 2 and Apple's number 3? Something like that. Anyway, and it's an incredibly successful business. And if you took the behavior of Steve Jobs, for that matter, any of the senior Apple managers, where there was shouting and yelling and belittling, how many unhappy staff complained about Apple? If you sort of threw your hands up and thought, no, I'm going to sell this stock, you would have missed out on the most epic gains in corporate history. Just got to be very careful how you judge these data points. That's, as I said before, that's one piece of information. There are lots of others. The magic is trying to collect all these different pieces of information and come to a decision. Let me move to something else now. There's a question here which is particularly pertinent, actually, because I was thinking this just the other day. Thoughts on WTC, which is, of course, WiseTech. Graham, I'm going to, not that you know.
Yeah, I was going to say, don't look at me. I hope you're taking over.
Okay. Let me talk about WiseTech for a bit. I'm quite interested in WiseTech. Nick, our analyst who covers WiseTech, did a great piece of work on WiseTech. The article is on the website if you want to go back and have a look at it. But internally for us, I think what Nick's done is really unmasked this business. I don't think I was quite aware of how this company worked and how high quality it was until Nick sort of brought it to our attention. And there's no doubt that this is a sensational business, top tier Australian business. And what I find really interesting about this one is that this has the potential to take 100% of the profit pool in its industry. And this is a remarkable thing because very few businesses do that. Audinate's one. The reason we have had Audinate on the buy list for such a long time is because it's probably going to take 100% of industry profits. And I think WiseTech, there's no certainty about that yet, but I think it's on track to taking all the industry profits. Extremely rare, extremely valuable. And if that happens, this business, which trades at sort of 120, 150 times PE, I don't think that's a crazy price for it. So it's one that we probably need to talk about more internally, need to do more work on. But it has fallen a little bit, and I don't think it's crazy. I think this is actually a legit idea that we probably need to put some more thought into. But thanks for bringing it up, Simon. Any thoughts on that one, Graham? It's probably not up your alley, is it? I can't imagine you buying a 100 PE stock.
Yeah, they don't jump out at me like that. But I do remember Nick did very good research on it, and it surprised me in many ways how the quality behind it. I kind of pictured it as being a very weak business or something that could be overthrown fairly easily. But yeah, he made a great case that it's, I don't know about any stock taking 100%. There just aren't that many of them that can take
I'm
all of their market. But
most of the profit pool in the industry.
But yeah, 100. You also shouldn't just judge it based on its current PE, because those kind of businesses can grow their earnings like far more than you can even imagine at the start. So,
well, I hate to throw at Apple. I keep talking about Apple. Apple, I think, is the best business in the world. But Apple has what 95% of industry profits in mobile phones. One of the largest industries in the world, and they take a 90% plus share of industry profits. That explains why it's a $3 trillion business, but it also shows that it is possible to actually dominate in the industry profit pool. And if you can identify those businesses that do, they can get extremely large, but also they're just very valuable. So it's a really important task to try and identify those things, and this might be one of them. Now, Graham,
and it's probably also it might also be the kind of thing that you need to just be mindful of portfolio weightings on those kind of stocks, because if they can take massive portions of the industry, they can usually also be displaced just as abruptly. And so, yeah, that can go both ways. If an industry can be taken over by one stock, if WiseTech doesn't happen to be that stock, then it's probably not worth all that much. But while things are running well, it looks it.
We probably have enough time for one, maybe two questions. I'm going to sneak in. I think this was quite interesting. Again, something I've been thinking about a little bit. Let me just get this up. It is from, sorry,
I like
cover
the
that.
Berkshire Hathaway one.
Yeah, I didn't miss that one. I'll go down to it in a second. Now, Steve asked, are there any stocks in the services sector you think have upside? Well, any stocks in the services sector you're looking at. Now, for me, that's interesting because I think I'm on record. I've had this view that the mining sector for about 10 years has underinvested in new capacity. And you're now seeing that shift. You can see in the capex numbers from the big miners and small miners, they are spending money. So there is revenue to be had in that services sector. We recently covered Duratec, which I think is a fascinating little business. If you haven't read that review, go back and read that. I think that's interesting. I looked at the result, was really impressed. It's one I'm going to go probably to the AGM, probably needs a bit more work, but I'm interested in. I own a little stake myself. I bought it just to keep an eye on it, but it's interesting. That's a great business. I must say, Monadelphous is back on my watch list as well. Just the quality is great. They have won maybe $500 million worth of contracts over the last few months, and you can see that moving. And Orica is the other one that's on my watch list. I think that's a high quality business that's been bombed out for a long time and probably needs some work. So those three I'm going to point to and say that probably I'm going to do some work on those, and you might see the result of that pop up from time to time.
Yeah,
Anything from you, Graham?
Good. In terms of services stocks,
yeah,
I leave it to you.
Okay, all right.
Mining services isn't my forte.
All right.
But we haven't talked about them for a while, so it's probably time to write something up about them.
I just thought you deserve something nice about you, Graham. So there you go. Someone said, "Good job." Hey, there was a question here I wanted to.
Thanks, Simon. You're my favorite member.
There was a question about margin of safety, which I wanted to bring up. I think I've lost it. Where is it? I'm going to find it. But basically, a member was asking, and I'll get it up as I can find it. My apologies, a lot here. I'll get up as I can find it. But the member was asking, how do you come to an assessment of margin of safety on a difficult stock? And they had, here we go. All right. How do you determine margin of safety in stocks such as Alumina? Now, Graham, you have, I think, a really well-defined and good understanding of margin of safety. How do you generally approach that when it comes to stocks?
Well, you can kind of take it two ways. You're either looking at the return that you think you can get based on the current price, or you can do kind of the business's valuation and look for a discount to that. The typical way kind of value investors are taught is that a margin of safety is a discount to the value of the assets or the value of the business, which I think is right in theory, but I actually think it's a lot easier to really kind of nail down what kind of return you think a stock is going to get, and then decide, is that adequate compensation for the risks that you're going to take. So I personally, I just find that a much easier method than the other way. They both kind of are the same in a sense.
But I like the mentality of that as well. You flip, instead of thinking about evaluation, think about expected return. And if you think of a PE of 10, it's an expected return of sort of a 10 earnings yield of 10%. So that's the way you think about it. Sorry to interrupt. Go ahead.
Yeah. I was just going to say, and I have a feeling that that's actually, we got a question about Berkshire Hathaway. I have a feeling that that's actually how Buffett thinks about it too. That you don't really hear him talking about a business's valuation, but you're always hearing him talking about the expected cash flows or the likely returns or adequate compensation versus interest rates and this kind of thing. That I don't think he's sitting there and thinking this business is worth $20 a share or something like that. I think he's thinking, how much money can this make over the next 10 years? Is it sustainable at that over the long term? And then is the price I'm paying today going to generate a decent return based on that? That seems a much, I don't know, more straightforward way of thinking about company valuations to me.
No, I like that a lot, Graham. That's excellent. I'll make a specific point about Alumina there because I think what Silu has cleverly sort of teased out is that under conditions of high uncertainty, it is really hard to come up with a margin of safety. And your point's well made. I completely agree. So we do have to do things a little bit differently when we have a high degree of uncertainty. I think it's a mistake, and I think a lot of investors do this, is they come to a stock which is with a highly uncertain outcome, and their first reaction is to run or to not look at it or to walk away. High uncertainty is absolutely crucial to getting a good deal, to get a good price. That's actually the optimal way to get a good deal, is to find a business with a high level of uncertainty. The difficulty is managing the risk in that condition. So the primary way we do that is through portfolio limits, and you'll notice that Illumina has a deliberately small, and I've spelled it out in words in the last review, deliberately small, deliberately strict portfolio limit, because if we're wrong about that one, you're going to lose money about it. And not even wrong. If the outcome turns out not the way I expect it to, then you're going to lose money on it. Okay. But the flip side is you just really got to go deep on the research as well and try and get a really strong understanding, so you can allocate a probability to a good outcome happening. And for Illumina specifically, we've got that mine, or the extensions on that mine have been approved every 5 years without drama since 1960. It would be a really big departure in policy, and a really big event for WA, for that state government, not to approve a mine that's been rolling over its approvals since 1960. What's that? 60 years. I think I got my math there roughly right. That'll be a really big deal. So I think it's an unlikely outcome, but it is possible. And so once you have that information, it's unlikely but possible. Control your portfolio limits, and I think that's probably the best way to think about it. And that idea might not be for everyone either. Not everyone wants to sit there with the possibility of losing a decent chunk of money. So think about that as well. But Graham, this idea of margin of safety, absolutely crucial. Love the way you think about it. There's that Seth Klarman book, right? Have you ever? I think he's doing an update. Seth Klarman, a famous US
Really?
investor, is doing
I've
an update.
I've read the
I heard
original,
he's
but
doing it
I didn't
again.
know he was doing an update. You don't mean that
Yeah.
he just did the edit for the new Intelligent Investor, or was it,
I
or
heard
was
on
it
a podcast,
maybe it was security analysis. I can't
secure
remember. He's
analysis, I
just
think it
done
was.
it.
Yeah, but
Yeah.
I did hear on a podcast he was writing a new version of margin of safety. But look, there
It'd
are
be
lots of
great if he
resources on
did
that.
to hear
I
his
agree.
current thoughts. Yeah.
I'd recommend that book just in closing. Seth Klarman has a book called Margin of Safety. You can get in PDF format. And if you find a physical version of the book, it's worth thousands of dollars because it is so rare and highly coveted. But PDF versions are pretty easy to find. Simple book, very easy to read. And many of our members would find it too simple, but I think sometimes it's good to remember all that simple stuff repeated back to you.
Yeah, I think it laid everything out in a very clear way. You could just tell clear thinking was behind it, basically.
Yep.
So
Right. Well, it's now 1 o'clock. I think we better let people go. Better let you go. And time to get out of my gym shorts, I think.
well, thanks
Thanks.
everyone for coming.
Yeah, thanks for everyone for coming. Graham stepped in on very short notice. I appreciate your time and efforts today, Graham. Thanks very much. And
Thanks for
Tom,
the invite.
who's playing God in the background there, controlling everything. Thanks for your help as well. If you have any, we'll try and do this from time to time, but as always, you can contact us for questions and keep an eye for some of the updates we spoke about today. Enjoy the rest of your day.